Hello, everybody. I really appreciate each of you coming to have this discussion with me about capitalization rates. A lot of what I've been speaking with people about has been capitalization rate focused because in a market where so much is unknown and so much is riding on the idea of risk, capitalization rates as the measure of risk is becoming increasingly important for people to understand. And so with a national scope in mind, I was hoping each of you could maybe review with me your market in regards to what we're seeing in capitalization rates in general. And then what we'll make sure to do is break it down by the major asset classes. And I hope that each of you will be able to contribute at least a few thoughts on each one. So right now, if you guys don't mind sharing with me, what's going on with cap rates right now and what are buyers and sellers saying these days?
I'll jump in first, Scott, since no one else is putting their hand up. Out here in Vancouver, we're seeing some resurgence in activity, but my chats with brokers and players in the market is people are still on the sidelines. And there has been, what transactions have happened, there's been flat on cap rates or a little upward movement depending on asset class.
Looking at Alberta, I think, we're seeing a bit of a mirror of what's happening in Vancouver. There hasn't been any transaction volume, which isn't a surprise. Generally speaking, there's apprehension around the office market in particular because the oil and gas industry is suffering and the impact of COVID has accelerated that decline. So, no one's eager to sell unless they have to or they're in a forced sale scenario and then they're going to be trading at a discount. All in all, the multifamily markets remain stable. Retail has its challenges and it's going to be tenant by tenant or asset specific, depending on the strength of the cash flows. And industrial has weathered the storm unless there's tenants in the properties that have specific exposure to oil and gas. And that, the tail is if there's exposure to oil and gas, there's an increase in cap rate and a perceived increase in risk and a more challenge surrounding financing. So that works to compress values, but that's kind of a high level snapshot, but we don't really have a lot of evidence. There was only one trade last quarter and that was negotiated. That was above $10 million and that was negotiated or pretty much finalized pre-COVID. So we don't have any specific benchmarks as of yet to point to.
Activity in Edmonton in particular has also been quite slow. There are some deals getting done or being negotiated right now. The brokers I'm talking to are saying that there is a lot of interested buyers if they can get something with really good pricing, if they can get a discount. And I've had clients tell me the same thing. But based on the conversations I've had, buyers are certainly expecting that adjustment and vendors may not be willing to give it right now. So we're still seeing a bit of a gap between the vendor and purchaser expectations right now. We did see some smaller trades of some multifamily assets. That might be the one asset class that is able to weather the storm here. I think there is obviously concern around retail and office and industrial as well due to the exposure to the energy sector.
Yeah, in Toronto, I mean, I'd echo pretty much everything that's already been said. I mean, obviously there's few transactions that have happened in the last quarter. The ones that did end up closing were, for the most part, lingering transactions from before the pandemic. But having said that, we have seen cap rates hold fairly steady right across the board. Obviously, you take it on a case-by-case basis looking at each transaction, but in general, I think things have remained fairly stable. Obviously, the more sought-after asset classes such as industrial, multifamily, office to a certain degree, transactions that we've seen close in those particular asset classes have remained quite strong. and even retail, on a case-by-case basis. Again, seen some assets close that have held up to pre-COVID pricing, let's say. So all in all, for now, things haven't moved much.
I think I'm a little bit more optimistic on Ottawa than the other markets. The benefit Ottawa has is that it has a large public service. We had few people unemployed as a result of COVID. Most work for the federal government, continue to work from home, continue to earn an income. So particularly in the sub 10 million commercial real estate market, cap rates have held strong, if not started to come down a little bit. Demand in the multifamily space has and continues to be immense. We're seeing many purchasers start to consider assets on a price per unit basis rather than on a cap rate basis. And the motivation for that has really been upside potential. Rental rates in Ottawa have increased substantially over the last 3 years, resulting in a lot of demand from those individuals looking to buy older buildings, renovate and flip units. Industrial Ottawa continues, there's a lack of supply, there's very strong demand. We had an announcement recently of a second Amazon facility being developed in Ottawa. Everyone wants industrial in Ottawa, but there's very few sellers. Office, no one's really selling office, and what is selling is good quality assets. I think if they're strategically located near public transit, if they have smaller floor plates, they're likely to sell. And I think anything that has a vacancy problem, they're just not being brought to market because those owners don't want to realize what could be a substantial reduction in value. Retail, like every other market, I think is the same question mark. We're not seeing any trades of large scale retail. We've seen a few smaller strip mall style developments with tenants under 5 to 2,000 square feet trade at pre-COVID levels. But anything big, there's been no activity. So I suspect we won't see any trades there. And if we do, we'll see some increase in the capitalization rate for those type of assets.
Well, for the Quebec market at the present time, pre-COVID, post-COVID, we haven't seen that much of a discrepancy in the cap rates just yet. What we are experiencing, and it's similar to the other markets, is a slowdown in activity. So pre-COVID, last quarter of 2019, first quarter of 2020, a lot of those deals were either pre-negotiated earlier or were coming to fruition. In the second half of this year, we have seen activity, but again, similar to the other markets, it's on an asset class by asset class differential. So industrial has had a few sales transacting. Multifamily has seen some activity. On the retail side, we're just beginning to see people who are interested, but unfortunately, it winds up being those who are all saying, I'm trying to look for a deal. I've had many clients call me saying, oh, by the way, we have some money on the side. If you know anybody who wants to sell something in this or this asset class, we may be interested. And then when I ask them, fine, but what type of a price are you willing to pay? Obviously, they think that they're going to be able to somehow capitalize on COVID and get a deal. But when I talk to the people who have the properties, they're, for the most part, sitting there saying, we know that offers that are going to come in are going to probably be not what we'd be willing to sell for. So I think what we're going to see, at least now till the end of second quarter and leading into the third quarter, as a general note, is that people who are interested in buying have to recognize that unless a seller is absolutely desperate, which could come to fruition over the next 6 to 12 months, that the next short term, say 3 to 6 months, won't necessarily see a high level of activity in certain asset classes because some people will try and weather the storm short term.
So gentlemen, if it's all right with you, what I'd love to do is maybe go into a bit more depth into some of the major asset types and get your thoughts on specific issues that are facing them. It's a great place to start is multifamily. And my experience has been that capitalization rates over the last 3 years have compressed in a dramatic way, namely because potential purchasers are looking at the upside in the rents as a better metric to what their risk is rather than the income in place. And I guess what I'm curious is there still demand for what's traditionally been one of the strongest asset types now that we see that people's income is starting to be threatened with mass layoffs in almost all industries across Canada. Tim, do you mind giving a few thoughts on that maybe?
Sure, yeah. Yeah, I mean, I think obviously, initially there was a concern with rent collections and, whether or not people were going to be able to pay their rents. I think we've sort of definitively seen that people are paying their rents. Most landlords are able to collect a good portion of their rents. Again, you take it on a case-by-case basis. There are some exceptions to that. But for the most part, we've been hearing that landlords have been collecting substantial amount of their revenue for each of their assets, pretty much right across the GTA. So, with that aside, you start to look at, what do rents look like in the future? We've seen perhaps a little bit of a dip in rental rates. I don't think that'll be a long-term trend that we see. I think it's more short-lived. And again, the long-term prospects for increased rental rates for the multifamily sector are quite strong. So I think that's why you're going to see a lot of investors looking to multifamily as an asset class that they'll seek now and in the future for its stability and for the upside potential.
Mark, how are things looking in Calgary?
I guess it depends on what type of multifamily asset you're looking at. The general consensus from the brokers is there is a little bit of apprehension because there's uncertainty around the strength of the economy and how that's going to impact people's ability to pay the rents that they're currently paying. There's subsidy programs now that I think are having a positive impact on making sure that people can afford to pay. And, the real question becomes what happens to rent collection once CERB runs out. And if the economy is not necessarily firing on all four cylinders, that may trickle down to higher defaults or bad debt. The other piece of the equation is financing in Alberta or Calgary specifically has become a little bit more difficult. So, the buying pool for certainly the smaller mid-market sized assets, 10 million and under, is compressed in finance, and you're not getting the same leverage. So, and although there haven't been a lot of trades, if you've got more stringent financing and uncertainty about cash flows, there's in theory there should be a modest reduction in value, but obviously sellers don't want to accept that, and vendors aren't necessarily willing at this point in time to pay or can't afford to acquire things because the financing isn't really available. I think if you're looking at larger institutional stuff, that stuff's more protected. It's not the same debt constraints and the people who can afford larger buildings. The tenants that are in those buildings are generally more well-heeled, and there's not as much cash flow constraint on larger assets from institutional guys, if there is institutions that are willing to invest in Alberta. So stability, but maybe, there is some apprehension for sure that may not exist in some of the other markets across Canada.
Well, I guess the thing that differentiates Quebec from the other markets is very strict rent control. So the three biggest factors that are controlling the activity, upside potential. Well, in terms of rent control, that's always been an uphill battle for any investor in Quebec. Then the other two things that fuel what we could call potential rental increase has always been immigration, and new people arriving to Quebec will tend to go to the apartment versus the rent versus the buy. That in itself will put pressure on our vacancy rates. Montreal and the Quebec market have now had historically low vacancy rates, things we haven't seen in a long time. In terms of what's been happening on the cap rate side, we have it's really dichotomous. It's two levels. There is low rise, which is stuff that you see inner city, and I would say that's probably characterized by 75 units or less. You've actually seen a continuing compression in cap rates, even during COVID, because the price point to get into the market is reasonable. And with financing, a lot of the people are either going CMHC insured and getting a higher leverage, or the banks are more apt or willing to look at multifamily right now because they view the risk as being lower, especially long term. And then when you get to high rise, the transactions themselves, the cap rates are more or less remaining stable. They haven't compressed yet. I think that in terms of people getting aggressive in terms of on the buy side, I think they're waiting and seeing. There hasn't been a large, from what we've seen and from people we've talked to, there hasn't been a large credit loss, because when you're sitting on a less than 1% vacancy rate, even if pick it, 3, 4, 5 units out of your 100-unit building are having trouble, in Quebec, it takes a long time to evict somebody. So the landlords have been working with their tenants to try and help them during COVID. So, the takeaway on the multifamily side is that the cap rates have, in certain asset and part of the asset class have actually compressed. There's still aggressive interest. On the more institutional side, the cap rates have remained stable. The factors that are going to determine it going forward will be whether or not how much of the rent control will control the upside, and then how much or how long it'll take for COVID to stop impacting immigration with our borders closed, with flights canceled and the like. You're not going to get a lot of cross-border immigration to fuel the demand to keep the vacancy rate low.
Thank you, gents. It sounds like across the board, while there is potentially some long-term risk in multifamily, for the most part, we're actually seeing that asset be quite stable, especially in different, qualities of the building, where there's a lot of demand, or at least willing buyers when they have the financing. To shift gears just a little bit, I'd love to chat about industrial, because every time I hear the conversation about real estate, industrial tends to be the success story rather than the place of risk. We hear of an increased desire for home delivery, that final mile in terms of logistics. And it strikes me that industrial users are far more able to practice social distancing as opposed to, say, retail or office. And so are we seeing any particular industries in the industrial market either excel or struggle amongst COVID? And is that having an impact on the rent that people are perceiving in industrial? Joel, maybe I'll get you to comment a bit on Edmonton first.
In Edmonton in particular, so many of the industrial tenants are tied directly or indirectly to the energy sector. So this is having a significant impact on a lot of these tenants. A lot of smaller businesses have struggled for years following the oil price crash back in 14, 15. And so there's a lot of tenants that really have just been hanging on, and COVID was kind of the final blow for some of these businesses that have given up now and they're shutting down. So it sounds like we're going to see a number of receivership sales in the case of owner users, and we're probably going to see some tenants defaulting as well. I think the small businesses are not the only concern in Edmonton, but also some of the larger national tenants. You may have a strong covenant and it's unlikely they're going to default on the lease, but if the businesses are struggling, it's more likely they're going to close locations or downsize upon lease expiry. I was just talking to a client who has a 100,000 square foot tenant. Big national company has no concerns about collecting rent, but their lease is up in 2 years. And he's terrified now that they're going to leave, and that 100,000 square foot space is going to be really difficult to backfill in Edmonton. So, another thing to consider is that pre-COVID, we had market vacancy in the 7 to 8% range, and leasing was pretty slow. So I would expect we'll see vacancy increase a little bit, which is going to put some downward pressure on rents. And theoretically, cap rates should rise to reflect that weaker outlook. So now, despite that, there's been some owner user land sales coming in over the past couple months. For the most part, they're not really showing any declines in pricing. I'm hearing there's still a lot of demand for small leased industrial assets. There's a lot of private money that still wants to get into the industrial market. So we may see only minimal cap rate adjustments on some of those smaller assets. For larger, lower quality assets, I certainly expect we'll see cap rates go up.
James, in Montreal, is it a similar story to what we're seeing in Edmonton, or is it a different behavior on the East Coast?
Well, so I mean, industrial, I guess the best way to put it is industrial has been the darling asset class for the last 6 months. And in fact, it's the last 18 months in Montreal or in the Quebec market. We were blessed or cursed with an undersupply of product for almost 15, 20 years. So when the market really took off, and that's the last 18 to 20 months, with the lack of supply and a lag of anywhere from 12 to 18 months to get new product to the market, the rents themselves as one component of value skyrocketed. Rents were, traditionally or historically, where they were $5.50 or $6 a foot, are now being released in the $8 a foot range. In fact, I just spoke to some of our brokers yesterday when I was in the office and to get some data. And a lot of space that's turning over is actually turning over at higher rents. On the sales side, on the cap rates, there has been some limited activity in the second quarter, a couple of sales, and the cap rates have remained stable. Buyers aren't getting aggressive in terms of wanting to pick it up, but industrial is viewed now as being the safest, call it safe haven of all the asset classes, because in Montreal there's just a lack of. Now, what we may see over the next little while will be a speculative build so that they can fill that void. But the net rents are going up. We still have incredibly low availability. Now, the only not asset class, but the only tenancy that is vulnerable will be the smaller bay users. And depending on what their business they're in, if they're not logistics, if they're not essential services, if it's not large space warehousing, they may be at risk in multi-tenant buildings. Obviously, a small 3,000, 5,000, 8,000 square foot building is a separate animal. But in a multi-tenant building that has 150,000 feet, if it has 6 or 7, 8,000 square foot bays, 1 or 2 may be at risk. But due to the absolute lack of product, even the brokers will agree that the moment they come to market, there's people that want them. So unfortunately, for every crash, there's going to be a startup who may think he can work. And then, depending on configuration of the particular building, if you have 2 8,000 square feet spaces next to each other and both are struggling, it's a lot easier to lease 16,000 feet. So there may even be some landlords that will actually look at that as a reprieve, an opportunity. And as I said, a lot of the rents are actually going up, not going down. So, even if cap rates remain stable and we can continue with that trend, the values will go up.
So it sounds like the biggest difference between Edmonton and Montreal was really one of supply prior to COVID. Vacancy rates being the main driver of rent, which then becomes the driver of the risk. And so I guess Oliver and Ottawa being a government-oriented city, are we seeing sort of a bridge of those two, or are we seeing a lack of supply in Ottawa as well?
So what's interesting, just thinking about James's comments, historically, one of the challenges with Ottawa was sort of, to a certain extent, limited our industrial rental rate growth. Now, I'll start by saying Ottawa industrial rates are amongst the highest in Canada, in many cases ranging from $10 to $12 a square foot. Historically, what's limited them going above that range is users go to Montreal. They say, you know what, I'm going to pay less, I'm going to move to Montreal, I'm going to save $4 a square foot, and I'll just relocate. Now that opportunity is ceasing to exist. There's a lack of available industrial land. We have seen some recent industrial land trades at pre-COVID levels, if not above pre-COVID levels. So the demand remains strong. There's a limited supply of industrial in Ottawa. So tenants don't have a lot of opportunity to relocate, move. It's very expensive to build industrial in Ottawa. It's such that because industrial land prices are driven so high by owner users, it's very difficult, if not impossible, to build an industrial building without a tenant in your pocket. All of which has pushed capitalization rates down, particularly for buildings that have current distribution tenants or distribution potential the cap rates are very low. So something with very good truck marshaling, good loading doors, and good access to highways would have significant demand from investors because they believe they can push those rents upward, thus are willing to pay very low cap rates for it. So, the market continues to be strong from an industrial perspective, and both in the large scale institutional space as well as for the 10,000 square foot and below owner user stuff. It all remains very strong and active in Ottawa.
So let's go to the polar asset, at least when it comes to how the news is reporting it. With industrial being relatively strong, I think I see an equal number of news stories where it details how retail is struggling. I imagine that most people who are interested in watching this video are very keen to hear what we have to say about retail. So, you know what, James in Vancouver, maybe you can start us off with, what are you seeing in retail, especially when it comes to the directionality of cap rates?
We, like a lot of the commenters before at the top of this discussion, there haven't really been any meaningful transactions, especially in retail. We did get word that there is a sizable deal, and I think it likely is to be north of 50 million, either conditional or unconditional. I think it is firm, but it's food and drug anchored and a good location. So that will be an interesting cap rate to measure once it closes. And there is an appetite amongst some of the vendors to let go of retail. Like most other guys on this call said, we're not seeing them desperate to sell, but just desire to be less weighted in retail, and maybe COVID and changing the dynamic of retail is going to accelerate that. I think Ivanhoe Cambridge had a plan to lower their weighting in retail. They had some of their properties on the market across the country, including 2 or 3 shopping centers here in BC. They didn't have a lot of success. And I think now they're just going to try and accelerate that. It was a 5-year plan, and maybe it's going to be truncated now. So it will be an interesting story to see when those come to market, and if there's any interest, if the pricing becomes more realistic on the vendor side. Another thing that I've been watching is the REITs. I think we all have. They became quite a good bargain for retail investors because the yields went way up on them, and it's really difficult to say if the RioCans and Smart Centers of the world will turn their ship around. They do have a lot of strength in some of their tenancy categories, but there are some that are decidedly challenged. Choice looks like it's a bit of a bargain as well, relatively speaking. And the good news there is they are mostly weighted on the food side, being Loblaws. Now, I saw a story come out today that said Loblaws lost 225 million. So their sales are way up, but I guess with greater volume comes greater costs. So I think we've seen that kind of story play out before, where in an effort to change direction, companies that look solid, like we thought at the beginning of this pandemic, oh, grocery stores are gold, they'll struggle a bit to adapt. It's going to be a change for them as well. But I'd say compared to other tenants, if you have a food anchored shopping center, you're probably going to fare quite well. And I think cap rates on that kind of stuff, if and when it sells, are going to be similar to pre-pandemic levels. The other thing I've been keeping an eye on is the number of store closures announced in Canada. By no means my list isn't exhaustive. I haven't been on top of everything, but by my count, there are over 800 announced, already happened or going to happen store closures in Canada since this started. This includes all of the Microsoft stores. David's Tea shut down a bunch of locations. Reitman's is in CCA protection. And Starbucks said they will close up to 200 stores in Canada. So, you know, these solid companies like Bed Bath & Beyond has announced as well. You know, companies like that I don't think are under threat financially, they're going to rethink things. And so I guess in time, retail will adapt and change. And cap rates will stay solid for well-located food-anchored centers, but other things, I think we're just gonna have to wait and see.
Similar to what Joel was saying, the lease renewal is going to really be the test of how strong the retail market is in British Columbia specifically.
I would say some originally negotiated deals are gonna be renewed lower.
And James, I'd like to quickly expand on what we were saying with the closures. I coincidentally also have a list of stores that have closed. The appraisers in us, we love making lists. You know, just in the last 3 months, you know, Tristan, which is a primarily mall-located fashion retailer, is closing 40 locations. Lucky Brand is closing 9 locations. Scholar's Choice, 13 locations. GNC has 29 locations. Frank and Oak, 22 locations. Those are just the recent ones. All of those groups are in some form of insolvency or receivership, attempting to reposition. All of them tend to have fairly weak online shopping presence. And I think that's the difference. So my curiosity is when some of these retail assets that are highly exposed to these types of tenants, when they're offered for sale, what's going to happen? I mean, I think in some cases, it's no longer going to be a question of cap rate, and it's going to be a question of what are the bricks and mortar worth on a price per square foot basis. So as you say, it's going to adapt. I very much so think we're going to see a big shift. I think the rental rates are going to have to come down on certain retail plazas. Building walls and redemising existing big box retail is very expensive. And I think the economics of it are difficult. Operating costs on retail are very high. So it should be very interesting in the coming years how that changes. And if some of these assets do in fact, with high exposure to fashion retailers, do get offered for sale, and what those cap rates ultimately look like.
In Edmonton, I'm aware of a couple deals, smaller centers under $15 million. And they're definitely showing some increased risk and caution on the part of the purchaser. You know, one of these is a good quality center, was tied up pre-COVID. The deal collapsed and a new purchaser came in, made an offer at more than 10% below the last price, which I think was more than a 50 basis point adjustment. The vendor accepted right away. They just wanted to get out and they had the offer there. Another lower quality mixed use center, they had an offer in 2019, significantly below the list price. They wouldn't even consider it. Recently, that same purchaser came back, made the same offer, and it was accepted. So, you know, these are only 2 deals, so it's tough to tell whether that's indicative of where cap rates are or whether it's a temporary situation. But certainly if you have, you know, lower quality asset, if you're not food anchored, bank anchored, I think that you need to expect cap rates are going to rise, at least in the short term. I would expect a grocery anchored center with, you know, bank limited CRU base, that pricing will still be near pre-COVID levels if we were to see something like that trade.
And Scott, if I could just chime in for 2 seconds on the Quebec. What we're seeing, I'm aware of at least 2 sales that are in the midst of negotiation. So it's smack in the middle of COVID. And in both cases, these are existing centers that either have excess lands or have areas that can be, repurposed. So what we're hearing in the market right now, and I'm not talking about super regionals, but even those are potentially on, up for repositioning. But what we're seeing on the community mall side is that transactions are going to be going forward, but the purchasers are buying them with the idea of repurposing parts of the center. So if they had excess parking or excess lands, what they're doing, the purchasers are doing, is they're willing to pay a reasonable cap rate for the sum of the whole, with the intention of perhaps building multifamily and now creating a multi-purpose property, which can provide not an experience to the multifamily, but direct access to a retail mall within close proximity. So I mean, I know of 2 actual sales that the negotiations are ongoing, and in both cases, I've talked to the purchasers, and when I asked them why they were buying them in light of COVID and the fact that, they could have some, go darks pretty quickly, they're looking at it as an opportunity. They're saying they're willing to pay a reasonable cap rate, something that might not be pre-COVID, but will not be a fire sale. Because they're saying, I now see upside in repositioning this, not just as retail, but as a multi-purpose property. So I think that, at least in our market, that's kind of the way some of the people are going to be going. Strip malls, it's anybody's guess, because those are the mom and pops. Whether they've made a requisite, maybe they've requested for financial aid from the government to try and get through, unknown. We are now in a reopening process economically. So, if there's no major second wave, some of those smaller mom and pop tenants may actually make it through. If they don't, we're going to see vacancy rates rise probably for the next 12 to 18 months. But when you want to get to the more institutional and larger investments, I think that the repositioning or repurposing, it's a better way of putting it, is going to be what we're going to see happening on a lot of the assets.
I think for years, a lot of those big regional and community malls had that potential, but the anchors were so strong that you couldn't get anything built. And the last 5 years, they've become a lot weaker. And now when landlords do new deals with smaller anchors, they don't give away the store the way they used to. So I think, yeah, you're right. You're going to see an acceleration of that repurposing.
So I guess now that we've covered industrial multifamily, where we've seen a fair bit of strength market depending, and retail, which is the struggling asset, what I'm very curious about now, especially given COVID really demonstrating a real opportunity for work from home, which is going to have an impact on the way office space is utilized. It may be far reaching, but has anybody heard or discovered how office is being treated as a risk profile with so much unknown about how it's going to be used in the future? And Mark, you had actually made mention of office being a struggling asset in Calgary. So do you mind starting us off with how office is behaving specifically?
Yeah, sure, Scott. I mean, it's no mystery to anyone that the office market in Alberta has been suffering for the past few years, and the COVID pandemic has just accelerated, the pressure on leasing, and which ultimately impacts value. Like currently in downtown Calgary, there's roughly 12 million square feet of vacancy, which equates to 27% of total inventory. And that's expected to climb past 30% in the coming year as oil and gas companies continue to lay off staff with compressed capital spending. So in a large part, Calgary's already seen the big hit, and the values have been battered. So now it's just a function of trying to wrap your head around what does a leasing picture look like and what is the impact. A lot of the deals for downtown space in B and C quality buildings are 0 or negative NERs, where if you look at the high quality A space, that those rates have actually stabilized, and there's been a flight to quality. So it depends on what type of asset class you're looking at, but and it depends on the leasing profile of the buildings. But for the most part, there isn't a lot of stuff available for sale, with the exception of now the strategic portfolio, which comprises predominantly B and C office buildings, which will be hitting the market in the coming year, I'd expect. A few of those properties have already started to trickle in into the marketplace and become available and are being marketed, but more of that will happen, I expect, in the coming 12 months. But largely, it's a leasing challenge. The outlook is continued compression in lease rates and NERs and investor caution. So, and it doesn't appear that there's going to be any major correction in the short term for Alberta. So there's just values and appetite and financing in the marketplace for office buildings in Calgary is down, and there's opportunistic buyers that are looking for deals and looking for leasing, but there's real risk in terms of cash flow, and that scares a lot of people away. And for the most part, there's no institutional investors who are actively seeking to buy product in Alberta, and we expect that not to change in the short term.
So I guess, Tim, the Toronto office market pre-COVID was actually quite strong with low vacancy from my understanding. So as Mark was saying that, Calgary struggled before COVID. So COVID isn't necessarily changing the profile, but it is prolonging it. Are we seeing a change in Toronto?
Yeah, I mean, I don't think so, not yet. Again, going back to just the number of sales, there haven't been that many. I mean, anecdotally, we've heard of a couple that have been in negotiations that are reportedly at cap rates that are quite similar to what we would have expected pre-COVID. So no change seen yet. I think for the most part in downtown Toronto, I don't think you're going to see a massive change going forward. Anything that does come to market is probably going to be a highly sought after asset. And, I think, it'll be bid on by players who are familiar with that asset class and who believe strongly that, the office is here to stay. I mean, fundamentally, will there be some changes long term? Probably. But I think for the most part, people would probably agree who are in the sector that, it's not going to have a dramatic shift in the sector so much that, you're going to see big swings in cap rates or underwriting methodology or anything like that. So, for the downtown market, I think things are going to remain fairly stable, both in the short term and long term. For the suburban markets, I think we could actually see, a change for the better actually in the suburban markets, whereby, companies are maybe looking for satellite offices now in suburban locations to support their staff in terms of, more sort of work-life balance, working from home, social distancing, spreading out, just having the ability to have multiple locations. So, I think that could be a great strength for suburban markets in terms of companies looking for assets in places where they may not have normally, sought office space. So I think that could be, a trend that we see going forward, which could actually, help bolster values and push cap rates down in those types of markets. So yeah, long term, I think in Toronto, I think things are going to stay fairly stable in the office sector.
James, similar to Toronto, Vancouver's also had a traditionally low vacancy rate. So would you echo the same comments as Tim, or is the increased amount of space that is being sublet starting to impact either rental rates or cap rates?
I'd mostly echo what Tim is saying. I think the downtown office market is still pretty desirable if you're an investor. There hasn't really been any product on the market, at least that anybody's talking about. The one potential wrinkle is the aforementioned supply that you just referred to, and talking to a few brokers, they said that when COVID hit, a lot of the tenants just went away. They put everything on pause. They didn't know what was happening. And they've started to come back, but they don't necessarily feel that it's not a landlord's market anymore in downtown Vancouver. I wouldn't call it a tenant's market, but it's definitely shifted in their favor. So that could be, I think, the future upward growth or growth expectations have maybe tempered a little bit in that respect. But I still think if an office tower came to market in downtown Vancouver, there's going to be a lineup of people to buy it. Suburbs, I'm not sure about that, because we just had a few transactions closed that popped up over 6%, which for the Lower Mainland is a bit of an anomaly in the last few years, but they may just be anomalies. So it's anybody's guess what's going to happen out there, but I think generally investors are being cautious in that category.
So I guess to summarize, and everybody can correct me if I'm wrong, but it sounds like the holding pattern that we're seeing in Q2 of 2020 is largely because the purchaser's expectation isn't matching the vendor's expectation. So it's really a function of who's going to blink first. Cap rates and market corrections don't happen when people don't want to buy. They happen when people have to sell. So I guess looking towards the future in each of your markets, I'd be very curious, and I know we've touched on it a little bit, but maybe to provide just some focused comments on what direction you think cap rates overall are going to go, and whether you think that it's going to be that the vendors can hold strong and keep their value expectation, or whether the purchasers will ultimately win out because they just outlast the vendors. Maybe we can start, James Gang in Montreal. We'll work our way towards the west.
So I guess, and again, without trying to say asset class by asset class, I think that assuming we can weather the storm the next 3 to 6 months, most asset classes, I think cap rates will remain stable. I think the weakest link within the asset class delineation would probably be retail. But I think that, you may see retail have an uptick short to midterm, the next 6 to 12 to 18 months, depending on the type of property, the tenancy, and what happens in the economy. So I think we will probably see cap rates maybe creeping up. I don't think they're going to increase dramatically, but if they were trading at a 5 or say 6, 6.25, you may get 6.5, 6.75. I think industrial will remain stable. You may even see a little bit of cap rate compression depending on the asset type. It also depends on the size of the size of the property. We have such a lack of 100,000 square foot plus product that, and for warehousing and or distribution, cross dock and transportation, all things that are now deemed essential. I think you may even see a cap rate compression there. If we're going to look at multifamily, as I said, rent controls, immigration, and the economy are going to delineate NOI. People will probably not get aggressive on the cap rate. I think what they're going to do is look at those fundamentals as to whether there's rental growth or not. So I think that, on the whole, Montreal's experienced, or Quebec has experienced incredible stability the last 18 to 24 to 36 months that we haven't seen. It was unprecedented for the last 10 years. I think that investors now see that Toronto may be a little expensive, Vancouver may be a little expensive, Montreal's still a bit of the darling. I think cap rates will probably remain stable in most asset classes. The most vulnerable will be retail, and the real question will be just how, and I don't want to use the term ugly, but just how how negative will purchasers perceive the risk. The vendors will have to realize that it's no longer the asset class that it used to be. Some vendors may choose to try and reposition themselves to make it more appealing to go to market with it. But and then on office, the only I didn't really chime in on office, but the only issue on office from an asset class and what's going forward on the cap rates will really be the sublease space that comes on the market in the Quebec market. If a lot of sublease space comes on the market and vacancy rates get above what we traditionally like to see, then you may see cap rates increasing slightly over the next 12 to 18 months. I know I've said this before, COVID is a once in a lifetime, once in 100-year event. We will get through this. The real estate industry will survive. The real challenge is the next anywhere from 6 to 18 months. But I think that on the whole, if I was summarizing cap rates for Montreal and for the Quebec market, most asset classes should remain fairly stable.
Oliver, do you mind providing some context on Ottawa?
Yeah, I mean, the only thing I'm certain about is that I'm uncertain about what cap rates are going to do or where they're going to go. It's a difficult question. I think that many owners who have assets that would demonstrate significant increases in capitalization rates, they just won't sell. I think they're going to do their best to, reposition their assets to a position where there isn't a significant increase in the capitalization rate. That being said, without a doubt, certain retail assets, there's just the risk profile of those assets, of a lot of retail assets, are a lot greater than they were. Cap rates are going to go up. Industrial, multifamily in Ottawa, today there remains good demand. Ottawa's a stable market. I think the only, the caution I'd have for Ottawa is with the comment, the recent news about the deficit that we're going to run this year, the federal government's going to run this year. Inevitably, austerity measures are coming to Canada. Is it probably 3 to 5 years down the road? Maybe. And when that occurs, historically, that's had a pretty big impact on Ottawa's commercial real estate market and the demand for it. So that's I think the only point of caution. I think retail cap rates are going to go up in some capacity depending on the asset, but office, the office market remains reasonably strong. Well-heeled assets will continue to be sought after by buyers. Multifamily and industrial strong. So really it's just that question mark of when the federal government scales back spending locally to start, I guess, stemming some of the bleeding from the various benefits surrounding COVID-19.
Tim, Toronto, final thoughts?
Yeah, echo a lot of the comments that have been said already. Again, I think things are going to stay relatively flat for the most part. We're a key market within Canada. I think, if you're an institutional investor and something comes up in the GTA that's well located near transit, has some good covenant tenants, good weighted average lease term. I think that type of product, generally speaking, across most asset classes is going to trade at fairly strong cap rates. If you start to falter in one of those areas, you might see some dips or increases, I guess, in cap rates. And then, I think going forward, again, I think, we're going to stay flat. And once I think the market gets confidence back, either in terms of, a vaccine or treatments or anything like that, I think things are going to be pursued even more aggressively in the GTA. So, I think that bodes very well for our market going forward. I guess it's just a matter of how long that takes and how quickly confidence is restored. But in general, I think, investors are looking to this market to spend their capital, and especially in, the three or at least two key asset classes, multifamily, industrial, again, office to a certain extent, certainly within the downtown core, and core product in the suburbs as well. So yeah, moving forward, I think we see, cap rates hold fairly steady in this market.
Joel, Edmonton?
Yeah, in Edmonton, I'm generally expecting an increase in cap rates. Like the other centers, it's going to be largely dependent on the specific asset. Multifamily cap rates, I think, will probably be pretty stable. If we head into a severe recession this winter, that could certainly change, but I do think that's going to be the most stable asset class. With each of retail, industrial, and office, I expect we're going to see some challenged assets that have to come to market, and we're probably going to see a few really high cap rates. On the flip side, the quality assets I still think are going to be in demand, and we'll see very, very mild adjustments to cap rates, if any adjustments at all. It's just a matter of time before we start to see some of those sales come through.
Mark, Calgary?
I think the Calgary market's going to mirror the Edmonton market to a large extent, with the exception of office. Cap rates for office are almost irrelevant now, especially for B and C quality product. That type of stuff is being priced on a per square foot basis, largely, unless there is term and security and leasing. I guess the big the big question is, without data points to point towards, it's trying to understand how people perceive the risk and cash flows. And I think the overall consensus is there is greater risk in yield, especially for office and retail. So the expectation in Calgary and Alberta, in a broader sense, is that cap rates should be moving up and value should be coming down. Or even if cap rates are staying steady, your achievable rents may compress. So that'll translate into lower value. So, with the exception of a well-tenanted industrial product with logistics or distribution type tenants, I think overall in Calgary, cap rates are going to be moving upward.
Process of elimination. You're the last one.
Like other James said, this is once in a lifetime event, or once in a generation event anyway. And so we're going to see some change in cap rate. I think, obviously, like everyone else has said, retail's in for a bit of a reckoning in the short term, and then potentially suburban office. But all of that aside, my, I guess, limited experience, but the beard says there's a bit of time here. Vancouver has mountains, border, and water, and we revert back to being a desirable market, I've noticed, quicker than anywhere else. And I think it's because ultimately, especially in this last run up, everything becomes a development play, or land value really influences value. So reverting to the norm, I think we're in for similar or cap rates to gradually move back to drifting downward.
So guys, thank you so much for your thoughts on this. And I know that as people watch this video, if they have questions about their individual markets, that they'll be able to reach out to you. So again, thank you for your insights. I look forward to the next cap rate report as more and more comes available in terms of information. I know that our cap rate will be able to reflect the ever-changing landscape, because if you had asked me in Q4 of 2019 whether or not I thought I'd be working from home for 5 months in 2020, I would have thought you were crazy. So it's amazing how fast things can change. So thank you again, and I appreciate all of your insights.
Thank you.
Thank you.